In 2015, Kraft and Heinz merged to create Kraft Heinz, the third largest food company in North America. Heinz is best known for its ubiquitous Heinz ketchup. Kraft owns many brands, including Kraft mac and cheese. The idea was that by combining these two companies, they could consolidate supply chains and reduce corporate overhead, thereby increasing profits. The company projected that it could achieve $1.5 billion of annual cost synergies within 2 years. One of the masterminds behind the mega merger was Warren Buffett. His company Berkshire Hathaway owned a 27% stake in Kraft Heinz at the time of the merger and retains that stake to this day. While Warren Buffett is revered as a legendary investor, nobody is infallible. Since the merger closed in July of 2015, Kraft Heinz stock has declined by 70%. Berkshire Hathaway has lost billions of dollars, making it one of Buffett's rare large failures. In September of 2025, Kraft Heinz announced plans to separate into two independent companies, basically reversing the merger from 10 years ago. In this video, we'll look at the rationale of the Kraft Heinz merger, why this failed so miserably, and why the company is now splitting up. Analyzing stocks is difficult. Even legendary investors like Warren Buffett can make mistakes. One tool I love to use is Investing Pro, the new flagship product from investing.com, which is also the sponsor of today's video. Let's take the example of Kraft Heinz. Just type in the ticker symbol in the search bar and you'll find a dashboard with all the headline numbers, like stock price, valuation metrics, and historical financials. You can go to the News tab, which shows recent news related to the company. Here we can see an article about the recently announced splitting up of the company. The Dividends tab shows the company's dividend history. We can see that in 2019 they massively cut their dividend. We'll talk about this in more detail later in the video. My favorite feature is the Chart tab, where you can make custom charts showing the financial metrics of any company you want to analyze. I used to spend hours pulling data from the company's SEC filings, but with Investing Pro, I can get these numbers instantly. Investing Pro also has proprietary AI models which create portfolios of stocks based on various financial metrics. For example, they have one called Best of Buffett, which has massively outperformed the S&P 500 over the past decade. It starts off with Berkshire Hathaway's portfolio and has an AI model that picks the strongest stocks within it. We can see all the stocks in the Best of Buffett portfolio. Unsurprisingly, Kraft Heinz didn't make the cut. Investing.com is currently running their summer sale, offering up to 50% off on Investing Pro and Investing Pro Plus. But here's the exciting part. I've managed to get you an exclusive extra 15% off on top of that. That means you can grab Investing Pro at the lowest price of the year, a total discount of up to 65%. Just click the link in the description to claim your subscription and start using Investing Pro today. This special offer is only available for a limited time, so don't miss out. And now back to the video. To understand why the Kraft Heinz merger was so disappointing, we first need to familiarize ourselves with the history of Kraft. In 2012, there was a food conglomerate called Kraft Foods. It produced two broad categories of food. The first category was grocery staples. This included Kraft American Cheese, Kraft Mac and Cheese, and Oscar Mayer hot dogs. These products are sold at grocery stores. By this point, these brands were very mature, so had few growth opportunities. They were distinctly American brands that would have little appeal in foreign countries. The second category was snacks. This included Ritz crackers, Oreos, and Chips Ahoy, just to name a few. These products are sold at grocery stores, but also sold at convenience stores. These brands had better growth prospects and were expanding into new markets all over the world. Kraft Foods believed that this second category was far more attractive to investors and could achieve a high stock market valuation as an independent company. The growth in the snack business was diluted by the stagnant grocery store staples business. So in 2012, Kraft Foods decided to split itself into two independent companies. The grocery store staples company would just be called Kraft. The snack business would be called Mondelez International, highlighting its focus on international expansion. So now Kraft was an independent company that was profitable but had stagnant revenues. This caused the stock price to trade at a relatively low valuation. In 2013, Warren Buffett's Berkshire Hathaway teamed up with a Brazilian private equity firm called 3G Capital to acquire Heinz. Heinz is the maker of its namesake Heinz ketchup, as well as other condiments. Berkshire and 3G Capital acquired Heinz for $23 billion. They split it 50-50, so they each put up $11.5 billion. The acquisition of Heinz fits in nicely with Buffett's investment philosophy. He is attracted to brands with strong consumer loyalty that have stood the test of time. Heinz certainly fits this bill. The brand has been around forever and is ubiquitous in most of the world. In 2015, Warren Buffett and 3G decided it would be a good idea for Heinz to acquire Kraft. They believed that Kraft was mismanaged with bloated corporate overhead. Even if the brands were mature and slow growing, they could nonetheless increase profits by cutting costs. In 2015, Heinz acquired Kraft in an all-stock merger, with the combined entity being named Kraft Heinz. Buffett and 3G Capital would own 51% of the combined entity, while Kraft's shareholders would own 49%. At the time, Kraft was significantly bigger than Heinz, so Kraft shareholders were not willing to merge on equal terms. To sweeten the deal, Berkshire and 3G agreed to pay a one-time dividend to Kraft shareholders worth $10 billion. The cost of this dividend was split equally between Berkshire and 3G. Following the merger, Berkshire Hathaway owned 27% of Kraft Heinz, a stake which it still retains to this day. 3G Capital was a big proponent of so-called zero-based budgeting, or ZBB. 3G had implemented ZBB at many companies they had acquired previously and planned to do the same at Kraft Heinz. Under ZBB, every department starts from zero each year and must justify every expense. Nothing is assumed to roll over automatically. Large corporations tend to get bloated, with unnecessary expenses and employees accumulating over the years. Under ZBB, every expense is scrutinized every single year. Costs deemed to be unnecessary can be quickly cut. Within months of the merger, Kraft Heinz announced to be laying off 2,600 employees and closing 7 factories across North America. They believed they could reduce costs by consolidating production into a smaller number of factories. At first, everything appeared to be going brilliantly. This chart shows Kraft Heinz's revenue and adjusted EBITDA. The merger happened in the middle of 2015. The 2014 and 2015 numbers are pro forma. In 2014 and the first half of 2015, Kraft and Heinz were independent companies. You add their revenue and adjusted EBITDA together to get the pro forma numbers. Between 2014 and 2017, the revenue of the combined entity declined 10%, from $29 billion to $26 billion. Kraft's main product is cheese. The decline in revenue can be mostly attributed to falling cheese sales. We'll talk more about cheese later. Even as revenue declined 10%, their adjusted EBITDA increased 22%, from $6.5 billion in 2014 to $7.9 billion in 2017. EBITDA is earnings before interest, taxes, depreciation, and amortization. Adjusted EBITDA also adds back stock-based compensation and one-time merger-related expenses. Adjusted EBITDA is a non-GAAP metric that supposedly represents the performance of the core business, excluding the noise created by one-time merger-related costs. So revenue was declining, but profits were supposedly increasing. When Warren Buffett and 3G Capital decided to acquire Kraft, they knew it was a stagnant and possibly even a declining business. But 3G's whole thing was cost-cutting. They believed they could cut costs faster than revenue could decline, thereby increasing profits. They were indeed able to cut a lot of costs by laying off redundant corporate staff and consolidating their factory footprint in light of declining sales. But in any business, no matter how bloated, there's only so much cost you can cut out. Mid-level managers were given aggressive and often unrealistic cost-cutting targets. Given that the company was reducing headcount, there was always the implicit fear that if they failed to meet these targets, they themselves could be fired. A lot of the managers started to get creative in how they would cut costs. They started proposing complicated payment structures to their suppliers. For example, they would agree to long-term contracts with suppliers in exchange for discounts up front. In other cases, they would accept upfront cash payments from suppliers in exchange for paying increased prices in the future. These weird contracts caused Kraft Heinz to pay more money to its suppliers in the long run, but created lower expenses in the current year. These types of schemes are not illegal in of themselves, but they do need to be accounted for properly. If you agree to pay higher prices to a supplier in the future, this creates a deferred liability that will offset the cost savings in the first year. The Kraft Heinz managers failed to account for these liabilities as they wanted to minimize costs in the current year so as to meet their short-term cost-cutting goals. In 2018, the Securities and Exchange Commission launched a probe into Kraft Heinz's accounting practices. In this probe, they found $208 million of costs that were improperly concealed by creative contracts with suppliers. We can see how the fraud escalated. In 2015, there was $25 million of hidden costs. In 2016, there was $26 million. In 2017, there was $100 million. In 2018, it was $30 million. The only reason it decreased in 2018 is because that's when the accounting probe began. These contracts trade lower costs in the first year for higher costs in future years. This necessitates even more fraud in the next year to offset the fraud from the previous years. That's why we saw the improperly hidden costs skyrocket to $100 million in 2017. Here we have Kraft Heinz's real financial performance. The numbers were adjusted for the accounting improprieties we just discussed. Revenue was steadily declining. By 2019, revenue fell to $25 billion, a 14% decline since 2014. We don't have pro forma operating profit numbers from before the merger. The company only provided non-GAAP adjusted EBITDA numbers, which are not directly comparable to operating profit. The first real operating profit number we have is in 2016, the first full year after the merger, where they made $5.6 billion. In 2017, operating profit increased to $6.1 billion. So some of the cost cuts were real. Not all of them were fake. But by 2017, they had effectively run out of costs to cut. Over the next 2 years, operating profits declined along with revenue. Kraft first started making cheese in 1916. They pioneered a new method of making cheese. The cheese was first shredded and heated to high temperatures, killing bacteria and mold spores. This greatly increased the cheese's shelf life. They also added emulsifiers such as sodium phosphate, which broke down the proteins in the cheese and prevented separation of the oils, thus keeping the texture stable over time. During both World Wars, Kraft cheese was included in the rations for US soldiers. This was for practical reasons, as the cheese could last a long time without refrigeration. It eventually came to be known as American cheese. It was popular due to its long shelf life, low cost, and consistent texture. However, there are some downsides. If you go to a grocery store and pick up a pack of Kraft cheese, you'll notice that it's not labeled as cheese. It's instead called a pasteurized prepared cheese product. Because of the emulsifiers and other additives, the FDA does not allow it to be called cheese. It's not real cheese. It's an ultra-processed food that has low and high-quality protein and high in sodium and saturated fat. In recent decades, many consumers have grown weary of the potential health risks of Kraft cheese. If nothing else, the fact that it's not even real cheese makes it suspect. In the later half of the 20th century, refrigerators became cheap enough to be ubiquitous in American households. If you have a refrigerator, the long shelf life of Kraft cheese loses much of its appeal. Kraft's other main product is mac and cheese. It has many of the same appeals of Kraft's so-called American cheese. It is cheap and has a long shelf life, but also carries with it many of the same health concerns. In the late 2010s, Kraft Heinz's revenue was on a clear downward trajectory, but they had a boost in 2020 with sales increasing 5%. If you remember, during the beginning of the pandemic, many people panicked thinking the world was about to end. People would go to the grocery store and buy as much non-perishable food as possible. Kraft was a big beneficiary of this panic buying. Their mac and cheese is dried and lasts pretty much forever. Even before the merger of Kraft and Heinz in 2015, both companies were large conglomerates created by the acquisition of many different brands over the years. Before the merger, approximately half of Heinz's revenue came from their namesake Heinz ketchup. Heinz ketchup sales have been relatively stable throughout this period. We've focused mostly on Kraft because that's where most of the problems are. Kraft also owns many different brands, most of which are pretty small and not worth analyzing independently. After their namesake Kraft cheese brand, their largest other brand is Oscar Mayer, which they acquired all the way back in the 1980s. Oscar Mayer is best known for its hot dogs, but it also makes other processed meat products, including bacon and lunch meat. Oscar Mayer is facing similar difficulties as Kraft cheese. Their products are highly processed and full of preservatives. They are perceived to be less healthy than unprocessed meats. Kraft's brands are losing market share to so-called private label brands, such as Costco's Kirkland brand. Other grocery stores, including Walmart and Target, have also been pushing their own store brands in recent years. Store brands are typically cheaper than name brands, as the retailers cut out the middleman. Name brands like Kraft Cheese and Oscar Mayer rely on brand loyalty to charge premium prices. You might be willing to pay slightly more for an Oscar Mayer hot dog because you've heard of the brand and maybe you've seen their Wienermobile. But Kraft, Oscar Mayer, and many of their other brands are no longer coveted by the younger generations. They are viewed as relics of the 20th century and are no longer able to command the price premiums they once did. As we saw previously, Kraft Heinz got a small boost from pandemic-driven panic buying in 2020. Since then, their revenue has been stagnant at about $26 billion per year. Their operating profit has remained stable at about $5 billion per year. The scope for cost-cutting has long since been exhausted. With revenue stagnant, there's really no way for profits to increase. Before the merger, both Kraft and Heinz were heavily indebted. In 2016, Kraft Heinz had $27.6 billion of net debt. This carried an interest expense of about $1.2 billion per year. At the time, they were making more than $5 billion of annual operating income, which was more than enough to cover their interest expense. They also have a very generous dividend policy. In 2016, they paid dividends of $2.35 per share, which cost them about $2.8 billion. In 2017, they raised the dividend to $2.45 per share, which cost them about $3 billion. In 2018, they raised the dividend again to $2.50 per share. The problem is, their profits were not increasing. They had to borrow money to pay for these dividend hikes. By 2018, their net debt had increased to $30 billion. You don't need a PhD to understand that borrowing money to pay your dividend is not a sustainable policy. In February of 2019, Kraft Heinz announced it was cutting their dividend from $2.50 per year to $1.60 per year. At the same time, they disclosed the SEC accounting probe that we discussed earlier. They also announced that they'd be recognizing $15 billion of impairment charges related to their Kraft and Oscar Mayer brands. These impairments were basically just an accounting technicality. When they closed the merger in 2015, they made some assumptions about how much revenue and profits these brands would generate. The brands underperformed expectations, so the company has to recognize an impairment charge. But this is not a real expense. It's a non-cash accounting technicality. With these three pieces of bad news hitting all at once, Kraft Heinz's stock price collapsed, losing a third of its value overnight. Many Kraft Heinz shareholders were dividend-focused investors. They were lured into buying the stock because of the high dividend. That dividend was unsustainable. As soon as the company cut the dividend, these investors abandoned ship. Cutting the dividend was a painful but necessary decision. It saved them about $1 billion per year, and they were able to start gradually paying down debt. From 2019 through 2021, Kraft Heinz also divested some of its non-core brands. In 2019, they sold some of their smaller Canadian cheese brands. In 2021, they sold their natural cheese business, including Breakstone's cottage cheese. They did not sell their namesake Kraft cheese brand. In 2021, they sold all of their nut brands, including Planters peanuts. In total, these divestitures netted them about $8 billion, which they used to pay down debt. By the end of 2024, their net debt had decreased to about $18.5 billion. Their current debt load incurs an interest expense of about $1 billion per year. Kraft agreed to merge with Heinz in July of 2015. At the time, the share price was $88. Today, the stock price is $27, a decline of 69%. However, we must also remember that as part of the merger agreement, Kraft shareholders received a $10 billion special dividend, which amounted to $16.50 per share. If we add that special dividend back, the decline is only 62%. But that's still a disaster. The single biggest loser in this affair is Warren Buffett's Berkshire Hathaway. Berkshire is the single largest shareholder of Kraft Heinz, owning 27% of its outstanding shares. Let's calculate how much they've lost on this investment. In 2013, Berkshire teamed up with 3G Capital to acquire Heinz for $23 billion. Berkshire put up half the money, so that's $11.5 billion. When they merged with Kraft in 2015, Berkshire and 3G paid a $10 billion special dividend to Kraft shareholders. Again, Berkshire put up half the money. That brings their cost basis up to $16.5 billion. Following the merger, Berkshire's 50% stake in Heinz turned into a 27% stake in Kraft Heinz. Today, the 27% stake in Kraft Heinz is worth $8.6 billion. Kraft Heinz has paid dividends over the past decade. In total, Berkshire's collected approximately $6 billion of dividends. If we add the current value of their share, plus the dividends received, the total value increases to $14.6 billion. So Berkshire's total loss is $1.9 billion, or 12%. A 12% decline doesn't sound too horrible, but we also must consider the opportunity cost. He made this investment in 2013. Since then, the S&P 500 index has increased 327%. Had he instead invested $16.5 billion into the S&P 500, it would be worth $70 billion today. By any measure, this has been one of the biggest blunders in Warren Buffett's otherwise legendary career. So let's see what he has to say about it. In 2019, Buffett gave an interview where he discussed what was going wrong at the company.
And we overpaid in Kraft. I don't think we overpaid in Heinz. And we borrowed money that related to projections that have not been met. We earn a lot of money, but we were paying out a lot of money, so we had very little in the way of retained earnings to reduce debt. So it's not as, packaged goods are not as good a business as they were. The really strong brands are, but we've learned that over the last few years as the struggle between the retailers and the brands has shifted toward the retailers, and that's why Kirkland is a very, very big brand. Walmart's going more to private label. There's some big forces on the other side. If you got a good enough brand, you can also call your term. Costco dropped Coca-Cola some years ago. They brought them back.
Do you see that ever shifting, or do you think that the game is going to be this way, weighted towards the retailers, except for the biggest brands?
it certainly looks like, particularly with the addition of Amazon to the picture. I mean, when you have Amazon and Walmart fighting, it's a little bit like the elephants fighting. You know, I mean, the mice get trampled, and I certainly don't see the retailer's position getting weaker. I mean, you have Aldi coming in and stronger. It's just and a lot of other players too, but two particularly strong players that have got their foot to the floor and to some extent will be pushing their own brands.
In September of 2025, 10 years after the two companies merged, Kraft Heinz announced plans to split itself into two independent companies. The two companies will be called Global Taste Elevation and North American Grocery. These are just placeholder names. When the companies are split up, they'll certainly come up with new names. When the split happens, existing Kraft Heinz shareholders will receive shares in both new companies. Global Taste Elevation will include Heinz Ketchup, Kraft Mac and Cheese, and Philadelphia Cream Cheese, among others. North American Grocery will include Oscar Mayer, Lunchables, and Kraft Singles. That's the American cheese or fake cheese. Global Taste Elevation is the larger and more profitable of the two. In 2024, its brands generated $15.4 billion of revenue and $4 billion of EBITDA. North American Grocery generated $10.4 billion of revenue and $2.3 billion of EBITDA. They're certainly positioning Global Taste Elevation to be the more attractive of the two companies. Kraft Heinz has not historically disclosed sales volume for each of its brands, but they have recognized billions of dollars of impairments. When they recognize the impairments, they do disclose which brands are responsible. The majority of their impairments have come from the Kraft, Oscar Mayer's, and Lunchables brands. The problematic brands are mostly within the North American grocery segment. The exception is Kraft. Kraft includes both Kraft Singles and Kraft Mac and Cheese. We know that Kraft has underperformed expectations, but we don't know if these impairments are related to Kraft Single, Kraft Mac and Cheese, or a combination of the two. The crown jewel of the portfolio is likely Heinz Ketchup. They haven't recognized any impairments related to Heinz. Also, remember what Warren Buffett was saying. He didn't regret acquiring Heinz. He only regretted acquiring Kraft. In hindsight, he admits that they overpaid for Kraft. He still believes that very strong brands are valuable and cannot be overtaken by generic store brands. He gave the example of Coca-Cola. Costco got rid of Coca-Cola, but they soon had to bring it back. Consumers are willing to pay a price premium for Coca-Cola. They don't want to buy the off-brand Costco Cola. Heinz is so globally ubiquitous that it's basically the Coca-Cola of ketchup. Try as they might, the grocery stores will never be able to displace Heinz with their generic store brand ketchup. Oscar Mayer and Kraft Cheese don't have this level of brand power. Maybe they did back in the 20th century, but those days are long gone. You can think of Kraft Heinz basically splitting itself into a good co and bad co. They have a few valuable brands, notably Heinz. They're splitting up the company so that the good brands don't get dragged down by the bad brands. At this point, you might be getting deja vu. In the beginning of this video, we talked about how Kraft was formed in the first place. In 2012, Kraft Foods split itself up into two independent companies. The good brands with better growth potential were put into Mondelez International. The bad brands with poor growth prospects were put into Kraft, which later merged with Heinz. This actually worked out pretty well. Kraft has been a disaster, but that's somewhat to be expected, as these were the bad brands. The split up of Kraft Foods happened in September of 2012. Kraft Foods changed its name to Mondelez International and spun out Kraft as a new stock. In the decade prior to the spin-off, Kraft Foods' stock price was pretty much stagnant. Following the spin-off, Mondelez has been a huge success. Its stock price has more than doubled, and it now boasts a market capitalization of $80 billion. Now we've come full circle. Kraft Heinz is proposing to do the exact same thing that Kraft Foods did back in 2012. Alright guys, that wraps it up for this video. What do you think about Kraft Heinz? Do you think it's a good idea to split up the company? Let us know in the comments section below. As always, thank you so much for watching, and we'll see you in the next one. Wall Street Millennial, signing out.